It is the biggest move for European bond markets since the 1990s. That's what we're going to figure out here today. An absolutely crazy day for the markets around some of the news we've seen of all places coming out of Washington, D.C., and the reaction to it. I'm going to figure out what that has to do with the euro and why it has been an absolutely explosive market in the past 48 hours. This is Ilya Spivak, head of global macro here at Tasty Live, and you're watching Macro Money. The headlines are coming fast and furious here, but the conversation to be had about stock markets hasn't really changed in a very dramatic way. The Wall Street response to all of this has been somewhat tepid. We've kind of come off the lows of recession fears over the past day or so, but that does not change what has been the really big impetus for these markets, and that's really the situation happening in Europe. So let's take a look at first what is going on against that backdrop, and then, of course, likewise, take a look at how all of this lines up with what is the next big influence for event risk, pertinent as it is, of course, the ECB monetary policy announcement, which comes at us in just mere hours. So the first thing to consider here, the price action itself. The move in the euro has been absolutely staggering. In fact, over the past 2 days, we have a rally of nearly 3%, which for currency markets, liquid and relatively constrained, though they are relative to others because of that liquidity, is an absolutely enormous move. In fact, this is the largest 2-day euro rally since November of 2022. What is motivating it? Well, we've talked at length on this show, and certainly updated on this last week, that the main driver has been, we can clearly see it here, the spread between German and U.S. 2-year yields. Put another way, however the relative power balance or the relative yield advantage balance looks at the front end of the yield curve, Europe versus the Fed, that's what you see in the euro. So when you get the Fed coming out and sounding very dovish, and the market says, whoa, that's too dovish, you're not going to do all these rate cuts, hold on, in September, there is a shift higher in U.S. yields. We, of course, see it with a massive sell-off in the U.S. Treasury bond market in a rally across the yield curve from September just up to mid-December and into the beginning of this year. And of course, in parallel, you get a strong U.S. dollar rally as the U.S. yield advantage expands. But since then, you can clearly see we've started to move the other way. And over the past 2 days, that move the other way has really gained a tremendous amount of traction. Ostensibly, this had to do last week to the past 48 hours with the idea that we've had relative stasis in Eurozone monetary policy expectations. We'll take a look at those in just a second, but the outlook for the ECB was mainly looked anchored at the same time that the story for the Fed was becoming less hawkish as soft U.S. economic data began to signal that maybe the Fed is going to have to do more easing than the markets were anticipating. As a matter of fact, looking at U.S. policy expectations since that fateful day on February the 21st, when we got that U.S. PMI data showing an absolutely eye-watering slowdown in the service sector. It wasn't quite the contraction initially reported, as we learned today. The revised set of numbers came out today and showed that no, the U.S. service sector ultimately did not contract in February. It did manage growth, but it was a very slow rate of growth. And it turned out that on the whole, when we look at just how much growth we ended up with sort of relative to history, it was the weakest since April of last year. So we're looking at a situation here that's not altogether supportive for U.S. yields going much higher. At the same time, those in Europe are holding up, and so the yield spread kind of starts to shift in the euro's favor. But boy, has it picked up steam. We can see it in these absolutely record-breaking moves here. And in the blue, what you see is Germany's 10-year yield. In the magenta is the corresponding bond. So you can see here the bonds, again, in the blue is the note, in the magenta, the yield. The note absolutely falling apart here. This is, in fact, the biggest sell-off in German bonds that we have seen in, just about 3 decades, give or take. And the impetus could not be more powerful, it would seem, on the euro. Why are we seeing this? Well, clearly there has been something of a geopolitical reshuffle that has gained momentum. Over the past day, we've seen that in the wake of last week's very tense exchange, let's call it, between embattled Ukrainian President Volodymyr Zelensky and U.S. President Donald Trump and Vice President J.D. Vance. In the aftermath of that, it clearly seemed like things were starting to gain some momentum toward a reorientation. But subsequently, the U.S. has moved to stop military aid, or to pause military aid to Ukraine, and to pause intelligence sharing too. That has really crystallized for Europe, it would seem. Of course, after Zelensky had that meeting, he promptly went to London for a meeting with UK Prime Minister Keir Starmer, as well as all of the continental European leadership. And the outcome has been that Europe has seemingly decided that it can no longer just rely on an American security guarantee, that it needs to dramatically rearm. News out of the European Commission, the president there, Ursula von der Leyen, saying that the region has agreed to look the other way on its own debt limits, to announce an $800 billion or 800 billion euro, some $840 billion package on defense spending. And at the same time, the incoming German Chancellor, Friedrich Merz, who just won the election, about 2 weeks ago, he has already reached a pact with rival SPD, Social Democrats for a Grand Coalition, and they've already agreed to suspend that country's even more restrictive debt brake to boost defense spending. Now, that's a whole lot of money flowing through fiscal spending into the regional economy. Not surprisingly, that's something that might be reflected in higher inflation, and you can see it in German break-even rates across the board. Just a brief reminder here, these are the measures of implied inflation expectations in the bond market, as reflected by taking the difference between nominal bond yields and inflation adjusted or real, as it were, bond yields. When you take that difference, you end up with the inflation adjustment that it takes to go from nominal to real, and tells you what the bond market thinks about where inflation is going. Well, here we are. Clearly, over the past several sessions here, we've had a dramatic upshift in Eurozone inflation expectations across maturities, not just the front end here in the red, but all the way out to the 20-year spread. All the way up here, everything is showing a massive shift in inflation expectations, and that, of course, giving us this massive upshift in rates. You can see it in ECB policy expectations too. And that, of course, is what is particularly in focus here as the ECB gets ready for a policy meeting. Now, we can see currently the deposit rate 2.75%, and for this March meeting, a rate cut is still all the way priced in. You're looking at 2.5. That much is probably not going to be a headwind for the euro because the markets have already discounted it, and in fact have discounted it for quite some time. We can see that these curves have not shifted very much at all on this question, going all the way back to October. So October, December, the January meeting, and now ahead of this one, all of these curves had rates at about 2.5% at the March meeting. So this rate cut is going forward, and it's been in the market for a long time. The larger question is what has happened with the direction of travel for the curve. And of course, we can see with this surge in rates, the curve has become much flatter. So the end point for the end of this year has now clawed back over the 2% line. And we can see clearly we're looking at the least dovish curve that we've seen out of this from basically the past 4 meetings. That is not quite telling the whole story. The move has actually been much more dramatic than it appears. And when we look at these sum totals for what's occurred, you start to really see it. At this point, we are only expecting 56 basis points in net rate cuts this year and next from the ECB. That is a dramatic rethink of what is going on. If you took a look at this just yesterday, that tally wasn't 56, it was 86, veering on 87. So what we've done here is essentially moved for the entirety of the outlook this year and next by a cumulative 30 basis points. That's a very big shift, and you can clearly see it in this dramatic jump in the orange line. For this year, the outlook has moved pretty significantly as well, from 88 basis points being baked in for easing this year, so erring on the side of 4 rate cuts, to now one of those cuts falling away. About 19 basis points gone out of this year's outlook, and we're down to just 69, maybe 70 basis points. So 2 cuts and a strong leaning toward a third. Moreover, the outlook for next year is starting to look like maybe we're going to start to see already a pivot in the other direction. So 14 basis points being baked in there. That's about a 56% chance, so a little bit better than even, of a rate hike of 25 basis points next year. So the situation has dramatically changed. Now, why are we so relatively stayed here? Well, at this point, as we mentioned, the reason why we got this shift already starting to happen before this surge is because ECB policy expectations have been relatively anchored, and it's the U.S. side that's gotten more dovish on the other end of the spectrum. And so we've had a shift that's been mainly US driven. Now, of course, we're getting a shift that's not just US, but also Euro driven in the same direction. The reason why things were relatively stable in Europe is they've been trying to figure out how to reconcile cooling growth and sticky inflation. In fact, we just saw updated Eurozone CPI numbers this week. They came in a little bit warmer than anticipated, 2.4% versus 2.3% expected. And if we look at the breakdown for what's been happening, we don't quite have the January numbers yet. They don't release that breakdown when they publish the early estimate of CPI that we got this week. But we can look back to December, and we can clearly see here still the trouble that the ECB finds themselves facing. The lion's share of inflation, in fact, the thing keeping the ECB from its target, is this stickiness in restaurants, hotels, essentially the hospitality sector. Take away that half of a percentage point, and you've got this thing down to 1.9%. But clearly, this has remained a sticky part of the equation. Influences from the energy side of things have come and gone, and that's actually explaining what's going on here. This is fuel costs. When you look at what's been the uplift in the miscellaneous component, it's been mainly insurance and mainly for vehicles. So that's a knock-on effect from what's going on here. Same thing for costs of transport. So all of this seemingly coming down to autos for the uplift, and that's come and it's gone, and now it's come again. This has been relatively sticky. And of course, the problem with it being sticky is that against this backdrop, the economy has been relatively anemic. We got a little bit of a revision in the PMIs that just was published today, the final versions of these numbers, but they don't really change the bottom line. The manufacturing sector continues to be in contraction mode. That may change with all of these defense spending outlays, but so far, anyway, the manufacturing sector below that 50 boom bust level for the PMIs that separates contraction from expansion. We can see, of course, the pace of contraction has eased a little bit recently, but nevertheless, we're below 50, so manufacturing is contracting. Services has slumped down to basically standstill. It's hugging that 50 line after 2 months of slowdown. The composite index taking in both, given how much services outweighs manufacturing in the total, looks like it's following the service sector, much as it does for most major economies. And so we are hugging neutral, we're hugging standstill on growth indications. So the ECB is a bit stuck before you have today's moves and yesterday's moves. It's a bit stuck because it can't really cut any more to boost this growth situation while inflation is going the wrong way. And of course, that slower economic conditions aren't bringing down inflation in what you'd think is a fairly discretionary spending, cyclically sensitive kind of a sector like hospitality. Tells you there's not an easy path into a trade-off here for the ECB. It's not easy for them to say, well, growth is slowing, so hospitality and hotels will disinflate because it's discretionary spending and the slowdown will take care of it. We have the room to start to cut a little bit more aggressively to boost the economy. Well, even before these latest moves, that was a tough sell. So the euro already was in a position where the outlook looked fairly anchored, and the rate cut was probably not going to be that much of a headwind for the euro. But what we now have is much more dramatic. Not only do you have this sticky inflation, but again, looking back at these break-even rates, now inflation expectations are dramatically marching higher, because if Europe is going to spend all this additional money on defense, then you probably have a whole lot more of a fiscal impetus toward inflation, and that's how you end up with the kind of rejiggering of the overall path for interest rates that you see here. That's how you start to shave away 30 basis points from the outlook. And then, of course, you're going to want to hear what ECB President Christine Lagarde says. Because if the rate cut is fully baked in, as we've seen already, there it is, then the larger question is, does the central bank, after the governing council's meeting, give you some sort of an indication that it is going to cut its cycle short, and this curve then perhaps is going to get something of a kink in it, where the long end starts to move higher, or perhaps we even just flatten out a bit more and go from the 70 basis points that are already on the menu for this year to a little bit less. But the impetus here for the ECB to jump out the window seems relatively low. Changing course and complicating fundraising efforts for regional governments at a time when they need to borrow a bunch of money to do all this spending probably isn't the likely next step. As long as CPI doesn't start to dramatically run away from target, the ECB probably has room to sit on its hands and do relatively little. So, if we're not going to get a more hawkish ECB, that seems unlikely, to say the least. If you're not going to get a more dovish ECB, then the meeting just represents event risk. With that in mind, looking back at the euro, now that you've hit 108 as an important inflection point here, we can see it's been acting as support, then resistance, then support, then resistance, now resistance again. Now that you've hit this barrier, you might see a bit of a pullback into the ECB just because the markets don't want to be tilted too far on one side or the other ahead of major event risk. They clearly have already front-run the central bank by a big margin here with this move, just slicing through former support, now acting as resistance here at the mid-106s and 107. So maybe you get a pullback here a little bit over the coming hours until you get to the ECB. Maybe that then gives you a tradable bottom from which to look for a long position at better levels. In any case, the risk reward to chasing this long now looking fairly shot as you're pushing nose up against this key barrier. So from a trading perspective, all of the ingredients for euro gains seem to be on the board. From a price action perspective, you probably have a bit of room for a tactical pullback or at least a confirmed close through this immediate resistance as the possible scenarios to start to think about how to be a buyer in this market. And if, of course, you're not a buyer already. And that's where the ECB opportunity lies, in that you have major event risk. You maybe have the opportunity for a little bit of a mulligan, a little bit of a pullback to look for an attractive place to capture this larger shift in the European macro backdrop. And that is Macro Money for today. As ever, we are here Monday through Thursday, right after overtime, a show I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and what may follow. I am likewise on with Chris for Futures Power Hour Mondays and Fridays, on with Victor Jones for The Price of Truth on Tuesdays, back with Victor and Tom for First Call on Sundays, writing for the news and insights portion of tastylive.com, commenting at Ilya Spivak on the platform formerly known as Twitter, and on Blue Sky. If you're watching on YouTube, like and subscribe. Macro Money's back tomorrow. Good luck out there.